All right, Great Depression, Chapter 18. The Roaring Twenties are roaring on, but something is very, very wrong. So let's find out what happens to the Great Depression. So what is the Great Depression? Well, it's usually a time period we look at sometime between 1929 and about 1941. It's really hard to pinpoint an end to the Great Depression, but we certainly have a start date, but we're not sure about the end. But anyway, it's a period in which the U.S. economy is severely depressed. Unemployment is extraordinarily high. Things go very, very, very poorly. So, pause here. So let's look at the Roaring Twenties. Were they all that roaring? Wages have been going up in the 20s. People had more money than they were used to. They were buying all kinds of things. It seemed to be going really well. Hoover's running for president, and he's promising a chicken in every pot. And he says, given a chance to go forward with the policies of the last 8 years, we shall soon, with the help of God, be in sight of the day when poverty will be banished from this nation. So we think, and we're talking about things as if it's all fantastic, and we will see the end of poverty, says Hoover. Okay, there will be no more poor people. The country is doing great and will continue to do great. But it's not what it seems. People are buying things on credit. They're using money that they don't actually have. They're spending above what they make. The businesses are expanding, all kinds of expansion in business. But they're expanding on credit too. They're borrowing money, money that they don't have. Banks are lending more than they have. So banks are giving out more money than they actually have. So everybody's operating on credit. The stock market's doing fantastically well. Been booming for the last couple of years. As the companies expand, the stock market's doing great because these companies seem to be making all this money and everything's going great and they're building new things and everybody's excited about it. Everybody wants to get into the market. Everybody wants to buy stocks. But what's actually happening is that the businesses are over-expanding. They think that they can keep expanding and keep expanding and keep making more stuff and more stuff and more stuff. And what's starting to happen slowly but surely is they're making too much stuff. And when you have too much stuff, prices are going to bottom out and nobody's going to want your product. And the businesses are going to go bankrupt because they're overproducing their product. But that's not what it looks like. So everybody wants to buy into the market and they want to get in while the companies are going up. So everybody starts buying stocks. And not only do they buy stocks, most people had never bought stocks before, don't understand the whole idea, don't understand what stock market is. And not only are they buying stocks, they're buying stocks on margin. They're using credit. They're borrowing money to buy stocks. So bank deposits, even the money that people put in banks, is being invested by the banks in the stock market. Everybody wants in the stock market. It seems like everything is going great and everything is wonderful and it will continue this way forever. That's what it looks like. So everybody keeps pouring money into expansion. They're buying more and more stuff. They're borrowing more and more money. They're investing more and more money, even money they don't even have. So it all looks good, but boy, it's going to be a mess. Pause here. Black Tuesday. Well, that can't be good. Black Tuesday. Stock's been dropping steadily since September. And it hits a pretty steep decline on October 23rd and 24th. People like JP Morgan, some of the other big people, Carnegie people like that, step in and try to stop the slide, try to prop up these companies and keep the prices up. And it looks like it's going to work until October 29th, 1929, a date that goes down in American history as Black Tuesday, horrible, horrible, horrible day. Here's what happened. All right. People start looking and seeing prices starting to go down, and they want to sell because they want to get out. They have an investment in the company. If they sell now, they'll get their investment back, and maybe they might make a couple dollars, but they want to make sure they don't lose anything. So they start trying to sell. Some people try to sell, and then other people notice that people are selling, so they want to sell. Everybody wants to sell before the price goes down. The problem with that is this: the more people sell, the lower the value of the stock. So if you don't get everything sold, you're going to be out of luck because the price of the stock is going to continue to go down. Your investment is worth less and less and less as the day goes on. Okay? And the people who sold in the morning are in pretty bad shape, but the people who sell by the afternoon are just done. As the price continues to go down and go down and go down, and people just keep selling and keep selling and keep selling, the stock market, the ticker, the thing that keeps track of stock trades, runs for hours after the close of the stock market to try to catch up. 16.4 million stocks traded that day. That is like quadruple the amount of things that usually happen. A crazy amount of selling going on that day. What did it mean? It meant that by November, okay, within a day or two, $30 billion has been lost in investments. $30 billion is gone. Okay? Companies have been devalued. People have lost all of their savings. People are jumping out of windows and committing suicide. And I'm not making this up. People are committing suicide. They have lost everything that they have. It is a disaster for Wall Street. Okay? That's why it's called Black Tuesday. Pause here. How bad was it? The market loses 40% of its value. Okay, you take a look at the graph down here. You can see 1927, the market's going up and going up. I mean, really going up. So if you invested here, you bought money, you bought stock, let's say in Ford Motor Company. Okay, by the time it got up to here, the market's going way up here. You have made a ton of money. Okay, but then notice what happens. Okay, little drop, huge drop. Okay, comes back a little bit, drops off the charts. Okay, until 1932 when it finally hits bottom. So how big of a loss is 30 billion? 30 billion is 10 times more than the whole federal budget in 1929. And it's more than we spent for the entire part of World War I. Okay, this is such a bad drop, starting with Black Tuesday, starting here with Black Tuesday. It's such a bad drop. It takes until 1954 for the value of the stock market to come back to what it was. Okay, this is a disaster. Pause here. The Federal Reserve had been set up by Wilson to control the money supply, to be the national bank, and it was supposed to stop things like this from happening, but it doesn't. It prevents, it doesn't prevent the crash of the banking system. It is severe contraction in the nation's supply of money because banks had all this money loaned out, and now that all the companies have crashed, people are starting to come to the bank to try to get their money back or get their money out. And they're trying to withdraw the money from the banks, but the banks don't have any money because the banks invested it in the stock market too, and now it's all gone. Okay? There is no money. All the money is gone. So people who put their money in the bank and thought it was safe, well, that's not true because the banks invested it in the stock market. When the stock market collapses, all the money's gone. 1929 alone, 600 banks are going to close because they cannot come up with money. Unemployment hits about 3%, which is not too bad, but by 1933, 11,000 of the 25,000 banks in the United States have failed. 44% of the banks are closed. Okay? Unemployment hits 25%. 1 out of 4 do not have a job. Okay? This is very, very, very bad. There is no money in circulation. There is no money to buy things. There's no money to invest, to create businesses. Nothing good going on here. Pause here. So what does the government do? Okay, the government's going to step in and try to do something. What does President Hoover do? He comes up with something called the Smoot-Hawley tariff. Smoot and Hawley are two senators. This tariff is supposed to protect farmers. Okay? It's supposed to raise the tariff on imported goods so that farmers can sell their goods. Because farmers, just like some of the other industries I've mentioned, have overproduced. There's too much product. They thought that everybody would keep buying forever and ever and ever, but now nobody has any money, and now they have too much product. So it starts to help farmers, this Smoot-Hawley tariff, and then it expands to other businesses. Everybody wants it to protect their industry. Well, that sounds like a good idea. We're going to, put a big tariff on all these products coming into the country so that people will buy our products. Well, the problem is this. The other countries retaliated. They raised their tariff rates. So now what you have is we can't afford goods coming into our country because of this Smoot-Hawley tariff. And other countries have raised the tariff on our products, so we can't ship anything out. So we can't bring anything in. We can't ship anything out. There's a huge reduction in world trade as people stop trading with each other because of the tariffs that are being imposed. This is going to really help fuel the depression. This is really bad. Okay, so look at the tariff acts and see what happens to the price of things. Okay, 1913 you could buy sugar for $1.26 a pound. By 1922 it was up to $2.21 a pound. By 1930 it's up to $2.50 a pound. Okay, it's doubled in 15 years. So you can see what's happening. I mean, cattle under 700 pounds, they were free, now they're 250. Butter was 2.5 cents a pound, now it's 14 cents a pound. Okay, so things have gone really high, really fast, and now people are looking. They don't have jobs. There's very little money. Their entire savings has been wiped out by the banks and by the stock markets, and now the price of goods is going sky high. There's huge inflation caused by this tariff. Things are really, really not going well. Pause here. It's hard times. In cities, urban areas characterized by shanty towns, people build, these are shanty town, anything they can find. They lose their houses. They don't have anywhere to live, so they throw up anything they can, anywhere they can, any public land. They call them shanty towns. Just throw up anything, cardboard boxes, anything you can find, make a house out of it. Okay? And they call these shanty towns. There's soup kitchens everywhere where people are coming in to get free food. Organizations like the Catholic Church, other private charity organizations have soup, and people are lining up by the hundreds, if not thousands, to come get soup because it's the only food they can get. Bread lines as people try to get bread. In the rural areas, a nightmarish disaster. Over 400,000 farms are foreclosed. To farm, you have to borrow money to buy equipment and to buy seeds and plant things. Well, the banks are going to foreclose on the farms because farmers can't sell their products and they can't pay back the loans that they have. The banks are going to come in and take over 400,000 farms and foreclose them. By 1932, the unemployment rate again was 25%, as people just don't have jobs. 1 out of 4 people don't have any job. They have no way to make any income. And it's just getting worse. Pause here. Here you can see a line for a restaurant. As the restaurant's handing out free food, and the people are lined up around the block to try to get some food, any food, because they just don't have anything to eat.